$10. Silver moved $10 in a single session, and if you weren't watching closely, you missed one of the most telling moves this metal has made in months. Right now, silver is sitting at a crossroads, and what happened between the overnight low and the New York Open tells you everything about who is actually in control of this market. Stay with me, because this is going to get very interesting. Welcome to the Quiet Markets. If you're new here, this channel is where we break down exactly what's happening in gold, silver, and the broader macro picture. In plain English, no jargon, no noise. If that sounds like what you've been looking for, hit that like button right now and subscribe so you never miss a breakdown like this one. Now let's get into it. Because what happened with silver in this session was not random. It was not just volatility. It was a very specific sequence of events that played out almost like a script. And once you understand the mechanics behind it, you'll never look at a silver price move the same way again. Let's start at the beginning. Silver was trading and it pushed down hard. We're talking about a move that took the price all the way down to the $77 level. Now that number, $77, is not just some random price on a chart. It's a level that a lot of traders and analysts had been watching for weeks. It was sitting right there like a magnet. And when silver finally touched it, something interesting happened. It bounced a full $10 from 77 all the way back up toward 87. That's not a small move. In percentage terms, that's roughly a 13% swing from low to high in a single session. And if you were positioned correctly, that was a trade of a lifetime for a lot of people who had been watching this level. But here's where it gets more complicated and more revealing. Because just as silver was climbing back up and looking like it had found its footing, the New York Open hit. And the New York Open dragged it right back down. Not all the way to the lows, but back to around the $84 range. And that pullback, that specific move, tells us something very important about the structure of this market right now. Think about it this way. You've got two completely different forces operating in this market. You've got the overnight session, which is more dominated by Asian and European trading, and then you've got the New York Open, which is where the big institutional money in the United States comes into play. And these two forces don't always agree on where silver should be priced. When silver bounced from 77, that was real buying. Somebody, or more accurately, a lot of somebodies, decided that $77 was too cheap for silver. They stepped in, they bought aggressively, and they pushed the price up $10 full. That's conviction. That's not a random blip. But when New York opened and pulled it back to 84, that's also telling you something. It's telling you that the New York crowd, on the bigger, more institutionally driven session, is not fully convinced that this bounce is the real deal yet. They came in, they sold into the strength, and they capped the rally right around that 84 area. Now, here's the million-dollar question. Or in this case, maybe the $10 question. Who wins this tug-of-war? Does the overnight buying pressure eventually overwhelm the New York selling? Or does the New York session have enough firepower to push silver back down? Maybe even retest that $77 low? To answer that, we need to zoom out a little bit and look at the bigger picture. Because silver doesn't move in a vacuum. Silver is always reacting to something. And right now, there are several major forces all colliding at once. And understanding each one is the key to figuring out where this metal goes next. The first thing you have to understand is the relationship between silver and the US dollar. This is fundamental. Silver is priced in dollars. So when the dollar gets stronger, silver tends to get weaker. And when the dollar weakens, silver tends to catch a bid. Now, right now, the dollar has been in an interesting spot. It's been somewhat elevated, but it's also been showing signs of fatigue. And that fatigue in the dollar is part of what's been giving silver some underlying support. If the dollar continues to soften from here, that's going to be a tailwind for silver. But if the dollar catches a second wind, maybe on some stronger than expected economic data, or maybe on some hawkish Fed commentary, that could be the thing that pushes silver back toward that 77 level, or even below it. The second force you need to understand is interest rates. The Federal Reserve has been one of the dominant themes in every single commodity market for the past couple of years. When rates are rising, the cost of holding silver goes up because silver doesn't pay you any yield. So higher rates generally mean lower silver prices. But when the market starts pricing in rate cuts, when traders start believing the Fed is going to loosen policy, that's when silver tends to take off. Right now, the Fed narrative is incredibly fluid. One week, the market thinks rate cuts are coming soon. The next week, some Fed official makes a comment, and suddenly everyone thinks rates are going to stay higher for longer. This back and forth is creating exactly the kind of volatility we're seeing in silver. The market genuinely doesn't know where rates are going, and that uncertainty is showing up in these wild swings. The third force, and this one doesn't get talked about enough, is the industrial demand story. Here at the Quiet Markets, we've covered this extensively, but it bears repeating. Silver is not just a monetary metal. It's not just a safe haven. Silver is a critical industrial input. Solar panels, electric vehicles, electronics, semiconductors. The green energy transition is an enormous and growing source of demand for silver, and that demand is not going away. In fact, some analysts are projecting that industrial demand for silver could exceed mining supply for years to come. If that plays out, it doesn't matter what the dollar does. It doesn't matter what the Fed does. A structural supply deficit is a structural supply deficit, and eventually the market has to price that in. So when you combine the monetary safe haven angle with the industrial demand story, you start to understand why silver has been trading at these elevated levels in the first place, and why bounces from key levels like 77 tend to be sharp and aggressive. Now, let's talk about the technical picture, because that's clearly what drove a lot of the action we saw in this session. The $77 level was being watched by a huge number of traders. You can see it on the charts. It was a prior area of support and resistance. Multiple times over the past several weeks, silver had approached that level and then bounced away from it. When a level like that is tested repeatedly, two things happen. First, the buyers who are waiting there get a little more confident each time it holds. They keep adding to their positions. They keep their stop losses tight just below it. And second, the sellers who have been pushing the price down know that level is there, and they know that if they can break through it, a lot of those buyers will panic and their stops will get triggered, creating a cascade of selling. That's exactly the setup that was in play when silver finally tagged 77. The question was, would the buyers hold it or would the sellers break through? And as we now know, the buyers held it decisively. A $10 bounce is not a weak defense of a level. That's a strong rejection. But here's what makes it complicated. The fact that New York came in and pushed it back to 84 means the bulls haven't fully won yet. 84 is now a critical level to watch. If silver can stabilize here and start grinding back higher, if it can clear 85, then 87, then push toward 90, that would be a very bullish signal. It would tell you that the overnight buyers were right and that the New York sellers were wrong. On the other hand, if 84 doesn't hold, if we start seeing silver slip back toward 80, toward 78, toward another test of 77, then you have to start asking some harder questions. You have to ask whether the bounce was just a short covering rally, a situation where traders who had been short, who had been betting on lower prices, decided to take their profits all at once, creating a temporary spike before the real selling pressure comes back. Short covering rallies can be violent and fast, but they're not sustainable. They don't create a new trend, they just create a window of opportunity for sellers to reload their positions at higher prices. So the next few days are absolutely critical for figuring out which kind of bounce we just witnessed. There's another layer to this story that we need to address, and that's the relationship between silver and gold. The gold-silver ratio. This is a number that a lot of sophisticated precious metals investors watch very closely. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio has averaged somewhere around 50 to 60, meaning 50 to 60 ounces of silver equals 1 ounce of gold. When the ratio gets very high, when you need 100 ounces of silver to buy 1 ounce of gold, that's typically a signal that silver is undervalued relative to gold, and that a reversion toward the mean is likely. Right now, that ratio is something worth paying close attention to. If gold is holding up well while silver is getting beaten down, the ratio gets stretched. And stretched ratios have a way of snapping back, often quickly and violently, in silver's favor. So even from that angle, the case for silver's bounce holding is not trivial. Let me also talk about what's been happening in the options market, because this is where a lot of the sophisticated money expresses its views, and it can give us some clues about where this is headed. When we see a big, sharp move like a $10 bounce in silver, one of the things that traders watch is what happens to implied volatility, the market's expectation of how much silver is going to move going forward. When implied volatility spikes alongside a big price move, it often means the options market is pricing in more chaos to come. Traders are paying up for protection. They're buying puts to hedge against further downside or calls to participate in further upside. That activity in the options market can itself create feedback loops in the underlying price, which is one of the reasons these big moves can sometimes beget more big moves. Now, beyond all the technical and structural analysis, there's also just the pure sentiment piece of this. And sentiment in the silver market right now is genuinely mixed. You've got one camp that believes we are in the early stages of a major new bull market for precious metals, that inflation is going to remain stickier than the Fed wants, that the dollar is in a long-term structural decline, and that silver, as both a monetary and industrial metal, is going to be a primary beneficiary. And then you've got another camp that's more skeptical. They look at the high price levels, they look at the still elevated interest rates, they look at a global economy that's slowing down in key areas, and they wonder whether some of the industrial demand projections are too optimistic. They worry about a global recession that could crush manufacturing output and reduce demand for the silver that goes into electronics and solar panels. Both camps make valid points. And that tension, that genuine disagreement between smart, informed people, is exactly what creates markets. It's exactly what creates volatility. And it's exactly why a $10 swing in a single session is possible in an environment like this one. Here at the Quiet Markets, our job isn't to tell you what to think. Our job is to lay out the landscape as clearly as possible so that you can make your own informed decisions. And the landscape right now looks like this. Silver bounced hard from a critical support level. The bounce was genuine and aggressive, but it ran into selling pressure at the New York Open, and it's been capped around 84. The next major move, whether it's a continuation higher or a rollover back to the lows, is likely to be decided in the next several trading sessions. There are a few specific things you want to watch. First, watch the dollar. If the dollar index starts rolling over from its current levels, that's silver's green light to run higher. If the dollar catches a bid and starts climbing again, silver is going to struggle. Second, watch the macro data. Any significant economic releases, jobs numbers, inflation data, Fed speeches, could be the catalyst that breaks this standoff one way or the other. Third, watch the gold-silver ratio. If gold is holding strong while silver lags, that divergence will eventually resolve. And historically, it tends to resolve in silver's direction. And fourth, maybe most importantly, watch how silver handles 84. If it bounces cleanly off 84 on any dip, that's a good sign for the bulls. If it slices through 84 like it's not even there, you need to start reevaluating the bullish case. I also want to zoom out one more time and make a broader point, because I think sometimes in the day-to-day noise of price action and session moves and New York opens and overnight lows, it's easy to lose the forest for the trees. And the forest, the big picture story for silver right now, is actually quite compelling. We are in a world where the energy transition is accelerating, whether you believe in climate change or not. The economics of solar power have become so favorable that governments and corporations around the world are building solar capacity at a pace that was unimaginable just 5 years ago. And every single solar panel that gets installed has silver in it, lots of it. We are also in a world where government debt levels in virtually every major economy are at historic highs. The United States, Europe, Japan, China, they all have enormous debt burdens that are only going to get harder to service as interest rates stay elevated. At some point, that debt pressure is going to create renewed inflation pressures, or it's going to force central banks to monetize the debt, to essentially print money to pay it off. Either outcome is historically very positive for precious metals, and we are in a world where geopolitical uncertainty is at multi-decade highs. Conflicts, trade tensions, sanctions regimes, all of these things create demand for assets that exist outside the traditional financial system. Gold and silver have filled that role for 5,000 years. They're not going to stop filling it now. So yes, the day-to-day price action is noisy. Yes, a $10 swing in a single session is disorienting. Yes, watching silver bounce from 77 only to get smacked back down at the New York Open is frustrating if you're a silver bull. But when you zoom out and look at the structural picture, the underlying demand story, the macro environment, and the historical patterns, the case for silver being significantly higher over the next 12 to 24 months is actually quite strong. That doesn't mean it's going to be a straight line up. It never is. There will be more sessions like this one. There will be more $10 swings. There will be more frustrating pullbacks, right, when it looks like the metal is about to break out. That's just the nature of trading in a market where institutional forces, retail sentiment, macro data, and geopolitical events are all colliding at once. What it does mean is that every one of these pullbacks, every retest of key support levels, is a moment where the longer-term thesis either gets confirmed or it gets broken. And right now, the bounce from 77 is a confirmation. The fact that buyers stepped in that aggressively at that level tells you there is real demand underneath this market. The New York pullback to 84 is a complication, not a defeat. It tells you that the rally needs more time to prove itself. It tells you that the bears aren't done yet. But it doesn't negate the significance of what happened overnight. A $10 bounce from a key technical level is a meaningful data point, and you should respect it. Now, before I wrap this up, I want to share one more thought. Because I've gotten a lot of questions from viewers of the Quiet Markets over the past few weeks about how to think about position sizing in a market this volatile. And I think it's worth addressing directly. When you're dealing with swings of $10 or more in a single session, the temptation is to either go all in when you think you've identified the bottom, or to stay completely on the sidelines, because the volatility feels too risky. Neither of those is the right approach for most people. Going all in at a perceived bottom is how people get their portfolios destroyed, because markets can and do go lower than you think is possible. But staying completely on the sidelines means you miss the moves when they do happen. The smarter approach, and I'm not giving financial advice here, just sharing what a lot of experienced traders do, is to think about building positions in stages. If 77 is a level you believe in, you might start with a partial position there. If it breaks and goes to 70, you add more. If it holds and rallies back to 85, you might add on the breakout confirmation. This kind of staged approach lets you participate in the move without betting everything on a single entry point. The key is having a plan before the price action happens, not after. Because when you're watching silver move $10 in real time, your emotions are going to be running high. The only thing that keeps you rational in those moments is a plan you made when you were calm. That's really the whole philosophy behind the quiet markets. In a world full of noise, of hype, of people screaming that the next big thing is here and you need to buy right now, we try to be the voice that takes a step back, looks at the data, understands the structure of what's happening, and helps you make decisions you can actually live with. The silver move we saw today, the $10 bounce from 77 and the subsequent pullback to 84 at the New York Open, is a perfect case study in why understanding market structure matters more than chasing price. If you understood why 77 was important, you weren't surprised by the bounce. If you understood the dynamics of the New York Open, you weren't confused by the pullback. And if you understand the bigger picture we've laid out in this video, you're not panicking right now. You're watching, waiting, and ready to respond when the next signal comes. There's going to be a lot more action in the silver market in the coming sessions. The setup is too charged, the forces at play are too significant for things to just drift sideways from here. Something is going to give, either to the upside or the downside. And when it does, we're going to be right here at the quiet markets, breaking it down for you in real time. If this video gave you a clearer picture of what's happening in silver right now, do me a favor. Drop a comment below and let me know what you think. Are you bullish on silver from here? Do you think the bounce from 77 holds, or do you think we're going back to retest it? I read every single comment, and I love hearing from people who are watching these markets as closely as we are. Your perspective matters, and honestly, the comment section on this channel has some of the sharpest minds in precious metals investing. And if you found this breakdown valuable, please share it with someone you know who follows gold and silver. Most people watching the financial news are getting the surface level story, the headline number, the one-line explanation. What we do here goes deeper than that. Share this with someone who's ready to go deeper. It costs you nothing, and it means everything to this channel. If you're not already subscribed to the Quiet Markets, now is the time. Hit that subscribe button and ring the notification bell so you don't miss the follow-up video when we see how this silver setup resolves, because it is going to resolve, and you want to be watching when it does. Thank you for spending your time here. Stay sharp, stay patient, and I'll see you in the next one.